Welcome to G Fun Facts Online. Today, we're diving into a piece of legislation that might sound a little dry on the surface, but it's poised to fundamentally reshape the future of money, not just in the United States, but potentially across the globe. We're talking about the dawn of a new, regulated digital dollar, thanks to a landmark law called the Genius Act. On July 18, 2025, President Donald Trump signed the Guiding and Establishing National Innovation for U.S. Stablecoins Act into law. This is the first comprehensive federal framework for stablecoins in American history, and its shockwaves are already being felt. So what exactly is this act? Why was it needed? And what does it mean for your money, the U.S. economy, and the future of digital finance? Let's break it down. Before we get into the nitty-gritty of the law itself, we need to be clear on what we're even talking about. What is a stablecoin? You've probably heard of cryptocurrencies like Bitcoin or Ethereum. Their most famous or infamous characteristic is their volatility. The price can skyrocket one day and plummet the next. That makes them fascinating for speculators, but pretty terrible for everyday transactions. Imagine buying a coffee, and the price in Bitcoin doubles between the time you order and the time you pay. It's just not practical. Stablecoins were created to solve this exact problem. They are a specific type of cryptocurrency designed to maintain a stable value. The most common way they do this is by being pegged or tied to a real-world asset, usually a major currency like the US dollar. So in theory, one unit of a dollar-pegged stablecoin, like USDC or Tether, should always be worth $1 US. This stability makes them incredibly useful for the digital economy. They can act like digital cash, allowing for fast, cheap, and global transactions without the wild price swings of other cryptos. But this stability has always rested on a foundation of trust. You have to trust that the company issuing the stablecoin actually has a real dollar sitting in a bank account somewhere to back up every digital coin it creates. And that trust has been shaken in the past. The spectacular collapse of the Terra Luna stablecoin in 2022, which was not backed by real-world assets but by a complex algorithm, wiped out over $40 billion in value and sent shockwaves through the entire crypto market. It was a stark reminder that without rules and oversight, these new forms of money carry immense risks. This is the world into which the Genius Act was born. For years, the U.S. has been in a state of regulatory limbo. Agencies like the SEC and the CFTC have tried to apply old rules to new technology, creating a confusing and uncertain environment. This lack of clarity has held back major financial institutions from entering the space and left consumers unprotected. The Genius Act is the government's attempt to finally draw clear lines, planting a flag and declaring the U.S. open for business in the digital asset space, but on its own terms. The journey of this bill to become law is a fascinating story in itself. It's a rare example of genuine bipartisan cooperation in a deeply divided Washington. The bill was sponsored by Republican Senator Bill Hagerty of Tennessee, but its co-sponsors included a broad coalition: Democrats Kirsten Gillibrand of New York and Angela Alsobrooks of Maryland, alongside Republicans Tim Scott of South Carolina and Cynthia Lummis of Wyoming. This shows a growing consensus across the aisle that stablecoins are too important to ignore and too risky to leave unregulated. The bill sailed through the Senate with a strong 68-30 vote in June of 2025, but it hit a speed bump in the House of Representatives. A group of about a dozen conservative members initially blocked a procedural vote, delaying its progress. Their concerns reportedly centered on whether the law gave too much power to federal regulators, like the Federal Reserve, a classic debate in American politics over states' rights versus federal oversight. However, a compromise was eventually reached, and the bill passed the House with an overwhelming 308 to 122 vote, supported by 206 Republicans and 102 Democrats. President Trump, who had campaigned on a promise to make America the crypto capital of the planet, quickly signed it, cementing the bill into law. So, what is actually in the Genius Act? Let's decode its key provisions. The law creates a new legal category for what it calls payment stablecoins. This specifically refers to digital assets on a blockchain that are pegged to a national currency, like the dollar, and are intended for payments. It's important to note what it doesn't cover. Algorithmic stablecoins, like the one that failed so spectacularly, or those pegged to other cryptocurrencies, are excluded. The focus is squarely on creating a safe, dollar-backed digital currency. The first and most important pillar of the Act is strict reserve requirements. This is the bedrock of the entire law. It mandates that any company issuing a payment stablecoin, now called a Permitted Payment Stablecoin Issuer, or PPSI, must hold reserves equal to the value of the stablecoins they've issued. This must be on a one-to-one basis. If they have issued $10 billion worth of stablecoins, they must have $10 billion in reserve assets. And these reserves can't just be anything. They must be held in US dollars or in very low-risk, liquid assets, like short-term US Treasury bills. This directly addresses the biggest fear in the stablecoin market: the risk of a digital bank run. If users lose confidence in a stablecoin and all rush to redeem their digital coins for real dollars at once, this one-to-one reserve ensures the money is actually there to meet the demand. It prevents a collapse caused by the issuer not having enough assets to back its tokens. The second key provision is the creation of a dual regulatory framework. This is a very American solution that balances federal and state power. An entity that wants to issue a stablecoin has two paths. It can seek a federal charter from the Office of the Comptroller of the Currency, or OCC. This path is open to subsidiaries of existing banks and credit unions, as well as new, federally qualified non-bank issuers. The other path is to get licensed at the state level, similar to how many financial services companies operate today. This dual system provides flexibility. A large, established bank might prefer the federal route, while a smaller, more nimble startup might find a state license more accessible. The primary federal regulators in this new landscape will be the U.S. Treasury and the Federal Reserve, giving them significant authority over this new form of money. The Commodity Futures Trading Commission, or CFTC, also gets expanded oversight, signaling a broader regulatory umbrella for the entire digital asset industry. Third, the Genius Act is laser-focused on transparency and consumer protection. Issuers are no longer allowed to operate in a black box. They must publicly disclose their redemption policies in clear, easy-to-understand language. They are also required to publish monthly, publicly available reports detailing the exact composition of their reserve assets. For the biggest players, those with over $50 billion in circulation, they will have to undergo a full, independent financial audit every year, just like a major public company. The law also cracks down on misleading advertising. An issuer cannot, for example, claim their stablecoin is legal tender or that it's issued by the U.S. government. Crucially, they are forbidden from implying their stablecoin is protected by federal deposit insurance, like the FDIC insurance that protects your bank account. This ensures consumers know exactly what they are and are not getting. Perhaps one of the most powerful consumer protections is the fourth pillar: priority for stablecoin holders in case of insolvency. This is a huge deal. In a typical bankruptcy, when a company fails, there's a long line of creditors, all fighting for the remaining assets. Employees, suppliers, lenders, and shareholders all have claims. The Genius Act says that if a stablecoin issuer or its custodian goes bankrupt, the people holding the stablecoins get first dibs on the reserve assets. Their claims are prioritized above all other creditors. This provides a massive safety net and should give users significant confidence that their funds are protected even if the issuing company fails. Fifth, the Act directly tackles the concern that cryptocurrencies are tools for illicit finance. Under the new law, payment stablecoin issuers are officially classified as financial institutions. This means they are now subject to the full force of the Bank Secrecy Act. They must implement robust anti-money laundering, or AML, and sanctions compliance programs. This involves Know Your Customer, or KYC, procedures such as verifying user identities, monitoring transactions for suspicious activity, and reporting to the authorities when necessary. This is a major step in bringing the crypto world into the same regulatory perimeter as the traditional banking system. Finally, the Act includes a provision to address potential conflicts of interest. It prohibits members of Congress and senior officials in the executive branch from issuing payment stablecoins while they are in office. The idea is to prevent policymakers from creating laws that would directly benefit their own financial ventures. However, this provision has drawn some criticism because it includes an exemption for the president, which some watchdog groups argue undermines the spirit of the rule. The impact of the Genius Act will be widespread. For the crypto industry, the regulatory clarity is a game changer. It removes the uncertainty that has plagued the sector for years. This is expected to unlock a wave of innovation and, crucially, attract more conservative institutional investment. Big pension funds, asset managers, and corporations that have been sitting on the sidelines due to regulatory risk now have a clear path to participate. For traditional financial institutions like banks and credit unions, this law opens up entirely new business models. They now have a clear framework to issue their own stablecoins, potentially revolutionizing payment services. Imagine international money transfers that take seconds instead of days, with minimal fees. Banks can also serve as the regulated custodians for the massive reserves backing these stablecoins, creating a new and stable revenue stream. For consumers and investors, the benefits are clear: enhanced safety and trust. The one-to-one reserve requirements, transparency reports, and priority in bankruptcy create a much safer environment. People can use and hold stablecoins with a much higher degree of confidence that their value is secure. But the biggest impact of all may be on the US economy and the global standing of the dollar. In an age where other countries, notably China, are aggressively pushing their own central bank digital currencies, the Genius Act is a strategic masterstroke. By creating a regulated framework for privately issued dollar-backed stablecoins, the law effectively encourages the tokenization of the US dollar. It ensures that the digital currency of the future is built on a foundation of US dollars and US Treasury debt. This will massively increase global demand for dollars, cementing the dollar's role as the world's primary reserve currency in the digital age. It's a way of projecting American financial power without creating a government-run digital dollar, which has raised privacy concerns. It's interesting to note that the Genius Act beat out a competing bill from the House of Representatives called the Stable Act. While similar, the Genius Act was seen as more comprehensive, particularly because it included clear rules for what happens when an issuer fails, a detail the Stable Act lacked. This focus on consumer protection in a worst-case scenario is likely what gave it the momentum to cross the finish line. The Genius Act is not the end of the story, but the beginning of a new chapter. The law is set to take effect 18 months after being signed, or 120 days after federal regulators issue their final rules, whichever comes later. Over the next year and a half, we will see a flurry of activity as regulators write the specific rules and companies prepare their applications. This legislation will undoubtedly shape the future of digital finance in the US and set a standard for the rest of the world. It's a foundational text for the responsible development of a technology that is transforming our very concept of money. The world will be watching as America embarks on its own, uniquely regulated, digital currency revolution. Thank you for joining us on G Fun Facts Online.